Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoy this episode. Thank you for joining us. Well, hello, this is Hall Martin with Investor Connect. Today I'm here with Kim Folsom of Founders First Capital. Kim, thank you for joining us.
Thank you for having me. I'm very excited to be here.
Great. Can you tell us about your background before joining Founders First? What did you do before this?
Certainly. So I've been a serial tech entrepreneur for over 20 years. Before starting Founders First, I founded, grew, funded 6 tech companies, exited 3, raised over $30 million in venture. And before that, I was an executive with a number of venture-backed companies. But I started my career as a software engineer for a number of financial service as well as telecom companies.
So what led you to start investing in the service business sector?
So I had, in my days as a CEO of tech companies, I did a little bit of angel investing. And being a underrepresented founder or diverse founder, whichever bucket that I get put into, I found that I was investing in other early stage companies. Many times I chose not to do a traditional equity investment, but instead did a revenue-based investment in companies that were generating but needed help with transitioning their models. So that was my first kind of dipping my toe.
So we have a lot of investors. What's your advice for people investing in underserved service-based businesses? What would you tell them about that?
Well, I would say in some respects, you have to be, look at them similar to how you might another investment, recognize that there's always risk associated with an investment. But the other side of it is there's opportunities with this underestimated market that so much capital is going to, the traditional next Facebook, unicorn wannabe type companies. But there's some really great service-based businesses with the right type of support and the appropriate relevant capital can grow to be nice-sized companies that can make a great contribution to communities as well as provide a good level return for them.
So how is this industry evolving? Where is it going?
Well, as from a impact investment standpoint, this is continuously growing. I think as people are seeing that the rationale for the unicorn, the next, be it, Facebook or Netscape or Netflix type of business, or even if you look at the very expensive privates like the Ubers and those are fair and far between. There are more folks that are looking to diversify their investment. And so they're looking at how can I have a triple win or a double win, do good and do well. So there's the current number for impact investment is about $280 billion, and that number is growing at a very fast pace. And then the other side of it is there's a recognition that there's been a gap in growth from revenue and job creation from a growing sector of businesses started by underserved, underrepresented founders, those that are, women, minority, military veterans, or in low to moderate area. So with that growth, folks are looking at how can I get a chance to take advantage of that? But how can I do it efficiently? I mean, not every deal, just like in a traditional business, traditional investing is a great investment. In fact, you have to be look at a number of areas from the opportunity, the talent, are they coachable, all of the things that they can make an impact. But with the right platform, it can be a great experience. And that's why more folks are looking to allocate and diversify their investment in that area.
So what is your specific investment thesis for service-based businesses? What do you look for?
So we look for a number of things. In some respects, we look at the opportunity, but we also look at the behavior and character of the founder. Are they coachable? Can, with the right coaching and the right level of resources, they can operate with transparency and be truthful, that they can add multiple recurring, highly profitable revenue streams, ideally add some tech enablement, that they're open to building a team, and they want to grow and add value significantly. So those are the key criteria that we look at for companies. The other key element is they have to have gone through our accelerator before we would consider for funding. And the other side of it is if we fund them, we continue to provide them with advisory support to help them grow, as opposed to just the typical passive investment where you write a check and hope that they're going to figure it out, or meet with them quarterly and not really be a resource to them. So those are some of the key components of our investment thesis.
So what are some example businesses that fit that thesis? Do you have any case studies you can share?
Certainly. We've got a number of companies. One was minority woman-led IT services companies, which had, before we start working with them, largely a project-based business, and had been for 3 years kind of stuck at a $400,000 level. And with going through our program, as well as being able to take advantage of our revenue-based funding and our post-funding advisory support, they've been able to grow their revenues 2.5 times. And this has been in less than 24 months that we've worked with them. They've grown their team from 3 to 9. And now they have 4 revenue streams, of which 3 are recurring. So that's been one of the great successes. We've also got companies that is in the healthcare space, and we're working to position them to be like a lynda.com, but for working with hospitals and medical plans to help them with being able to deliver care to a diverse marketplace. But there's lots of different learning tools that can be used in a way to kind of track their performance. So that's one of the other companies in our portfolio. We've got another one that is a company that is helping folks with autoimmune disease that are kind of bedridden, and being able to provide diet and exercise related folks that are bedridden and making it easier for improving the quality of life. So a variety of different great companies that we've been able to help.
So what are the challenges in investing in service-based businesses?
Well, traditionally, many of these small businesses start with a great idea, and they may go and generate revenue, but they're stuck in a model that may need to evolve so they can improve their value to their customer. So if they stay in that pure transactional model, which most small businesses are in, they go through such highs and lows without being able to weather some of the economic challenges. And so it's being able to recognize those potential businesses that, with the right type of support and a teachable founding team, can make that transition and have that occur, and recognize that not only are those pieces are key, but with regards to customer acquisition to make that transition, can they make that transition in what we call a crawl, walk, run methodology, because everything takes time to do it. So those are some of the challenges, is that it does take time to make that transition, and to have them turn that curve in 12 to 24 months. And as a result, and they have skin in the game because it's a revenue-based methodology that we work with. So if they're not open to those things, and from the behavior based on their time in our pre-funding accelerator, then those are examples of companies that it's not worth our time to participate with.
From the investor's point of view, what are the top 2 risks that an investor needs to mitigate in this space? Is it avoiding those with margins compressing? Is it the swing in the economy up and down? Or what are the risks that you think that investors should be on the lookout for service-based businesses?
Well, one is that you brought up the point about their gross margins. That's really key. If you're operating below 40% margins, you're at a significant amount of risk. Those companies that may be operating with the 20%, 25% gross margin, which a lot of them are, those are a huge risk. And so that's one of the things that we work with the companies to get to, at least the 40% gross margin, ideally north of 50. So that's one. And then the other is the coachability. Are they willing to make those adjustments and do some things that they haven't done before? A third area is with regards to where are they in the value chain from their customers. There are a lot of small businesses that just kind of go through the motions of delivering value without delivering services without really checking in with their customer to kind of see where they're adding value and how they value their competition. And so there has to be that transformation that they need to go through, or be open to looking at, where do I sit in the whole marketplace, and I'm going to have to adjust and evolve my company so that I can add more value to my customers, and as a result, increase the amount of money that they're going to pay for whatever services I'm providing. Because operating purely south of 25% gross margins is a very, very tough business to survive.
Well, in the world of service-based businesses, there's many sectors. Where would you think the immediate opportunities are? Which sectors are the best ones to pursue at this point?
Well, we've got, I would say, 6 sectors that we have had an experience working with today. IT services is one, because that's a growing sector. Health services, and outsourced administrative services another. Facility-based services, there's some hospitality-based services, to name a few. And then there's some unique ed services are the other one, where there's maybe some, either you can think of them as either apprenticeships or personal development type of certifications that companies can provide to help professionals or help companies with licensed or certified professionals be able to stay up to speed. So that's what we've seen thus far, the 6 sectors that have been promising.
Great. Well, in the last few minutes that we have here, what else should we cover that we haven't?
I think that the other is the methodology that we use to fund companies, as I shared, is a revenue-based fund. It is different than the traditional items, be it methods that our companies are funded, either the traditional debt or equity. And so that's a new nuance that many investors have to work to get their head around. The way that works is, for our model, is for every dollar that the company generates of net cash receipts, they pay a percentage royalty, could be 5%, and that's what's used to do the quarterly distributions. And it's, as I said, it's kind of a boutique model. It's been around for decades, but if you look at the large majority of funding either private companies, it's been either traditional debt or equity.
Great. Well, how best for listeners to get back in touch with you?
There's a few things that I can suggest to them. First, I want to thank the folks at 10 Capital that has given us the opportunity to share our story with them. So that's one. But the other is through you can visit our website, which is foundersfirstcapitalpartners.com, or by email. You can connect with me at kfolsom at F as in Frank, the number 1, S as in Sam, T as in Tom, C as in Cat, P as in Paul.com. And lastly, you can connect with me on LinkedIn, Kim Folsom, always pretty prompt at responding there.
Well, great. Well, we'll put those in the show notes so people can click through to them to catch up with you as well. I want to thank you for coming on and sharing this information with us now, and hope to have you back for a follow-up soon.
Thank you. I appreciate it. Would love to share insights of revenue-based financing with folks. So thank you for the opportunity.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.